Hello, I'm John A.G., and silver didn't just move higher. It snapped, not slowly, not carefully. It moved in a way that usually only shows up when something underneath the market stops behaving the way it's supposed to. This was not a technical breakout you circle on a chart and forget about. This was silver, accelerating upward with urgency, pushing straight into the 107 area without hesitation, without the pauses that normally calm traders down. Moves like this don't happen in quiet environments. They happen when pressure has already been building and finally finds an outlet. Silver opened near the low 100s and then pressed higher relentlessly. There was no orderly stair-step, no polite back and fill. It simply advanced fast enough to force attention and sharp enough to stress positioning. That kind of price action doesn't come from optimism. It comes from necessity. And the most important thing to understand is that this did not feel like emotional panic. It felt structured, almost mechanical, as if multiple participants reacted at the same moment for the same reason. That distinction matters because panic is chaotic. This wasn't. This looked like the result of decisions already made behind the scenes, finally hitting the price. And while the U.S. market was absorbing that move, something else was happening that made the situation impossible to ignore. When Asian markets came back online, Shanghai didn't merely confirm the move, it exaggerated it. Prices there spiked above U.S. futures, printing noticeably higher levels before easing back. That behavior is not normal, and the relationship between those two prices is where the real signal lives. When Shanghai silver trades at a premium to U.S. prices, it tells you that demand for physical metal is concentrated there. It tells you that buyers are willing to pay more, not because they like the price, but because they need certainty. Normally, arbitrage smooths that out. Metal flows. The cheaper market rises, or the expensive one falls. The spread closes. But last night, the sequence mattered. The premium widened first, showing urgency. Then it compressed, not because demand faded, but because U.S. prices were pulled upward to meet it. That is not coincidence, that is transmission. This is where simplified explanations fall apart. One narrative says a major U.S. bank is trapped and being forced to cover. Another says China is desperate for metal and is driving prices higher. Both stories sound clean, but markets rarely move cleanly. If one side were decisively winning, the other would be benefiting. What this looks like instead is something less dramatic and more dangerous: widespread defensive behavior. This was not an offensive squeeze. It was a retreat into resources. Multiple players acting independently, responding to the same risk. In a world where supply chains can be disrupted, sanctioned, delayed, or redirected overnight, availability matters more than price. When access becomes uncertain, nobody waits for dips. They secure what they can, even if it hurts. That is the line between speculation and usage. Speculators debate levels. Real users secure inventory. And silver sits right at that intersection. At these prices, silver is not an abstract financial instrument. It is an input. Solar manufacturing feels this immediately. Silver is essential in photovoltaic cells, and even though manufacturers have reduced silver content per panel over time, scale overwhelms those efficiencies. When silver jumps, costs jump, margins compress. And when procurement teams see silver moving like this, they don't gamble on a pullback. They pull purchases forward, they lock supply, they reduce uncertainty. The same pressure applies across electronics, medical equipment, and industrial applications that rarely make headlines. The key point is that industrial silver demand does not need to dominate total demand to move the market. It only needs to be inelastic in the short term. If production requires silver, buyers will pay up. Recent industry data shows industrial usage in the hundreds of millions of ounces annually. That means even modest disruptions create outsized consequences. This leads to a question that changes how this move should be interpreted. For years, the assumption was that investment demand would lead and industry would follow. But what if that order has flipped? What if industry is already front-running the public because it has no choice? If that's the case, fading spikes becomes a dangerous habit. The bid underneath the market isn't just speculative money anymore. It's operational demand, and operational demand doesn't respect chart patterns. Now consider the financial layer, because this is where stress becomes systemic. In the U.S., silver flows through futures, options, clearinghouses, and bullion operations. A sudden move to $107 stresses any large short exposure, whether intentional or structural. That doesn't require a single institution to fail. Disruption alone is enough. Volatility increases margin requirements. Liquidity assumptions change. Risk managers tighten limits. Even firms that can trade around volatility don't enjoy disorder because disorder clogs the plumbing. And this pressure doesn't need to be one-sided. China can feel pain through rising input costs and delivery uncertainty. U.S. financial players can feel pain through stressed positioning and market structure. Both sides can be trying to reduce damage at the same time. That's why this move looks defensive rather than aggressive. Nobody is celebrating. They're adjusting. Zooming out makes this clearer. Silver doesn't trade in isolation. It sits alongside copper, oil, rare earths, and other critical materials that have quietly become strategic assets. Over the past few years, supply chains have been politicized. Export controls, sanctions, shipping disruptions, and regional influence have turned raw materials into leverage. Countries stockpile not because it's efficient, but because being cut off is worse. Silver is being pulled into that reality, not because it's uniquely important, but because it touches money, industry, and security all at once. Production is geographically concentrated. Refining and shipping routes create choke points. Financing and delivery matter. When global powers start caring about the same regions at the same time, supply chains harden. Everyone tries to lock up access early. If one side believes access may tighten, it buys. If the other side believes the same thing, it also buys. That's how prices move violently without a mastermind. This brings us back to the Shanghai premium, because it exposes the real constraint. Arbitrage only works when metal can move freely. When logistics, export rules, financing costs, and delivery timelines interfere, spreads close through price, not flow. The cheaper market gets dragged upward because the buyer with urgency is willing to pay whatever it takes to avoid disruption. A persistent premium is not a paper signal, it's a physical one. And physical constraints don't resolve overnight. They resolve with time, coordination, and infrastructure. Time is exactly what stressed buyers don't have. That's why moves like this don't fade easily. They pause, they consolidate, and they test conviction. But the underlying issue doesn't vanish just because price stops moving for a day. Silver at $107 is not just a number, it's a message. It's telling you that availability is starting to matter more than comfort, and when that happens, markets stop behaving politely. What makes this situation more unstable than it appears is how little flexibility the silver supply chain actually has. Silver is not a market where higher prices instantly create more output. A significant portion of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dictated by the economics of other commodities, not by silver itself. Even if silver prices surge, mines cannot simply flip a switch and flood the market with new metal. Mining projects operate on long timelines. Permitting takes years. Capital requirements are high. Ore grades decline over time. Energy costs matter. Labor matters. And most projects only move forward if the primary metal justifies the investment. Recycling provides some relief, but it has limits. Silver is dispersed in small quantities across millions of products, making recovery slow and often uneconomical. All of this makes the silver market far more sensitive to demand shocks than many participants assume. This is why sudden price moves tend to overshoot. When industrial buyers decide they cannot risk waiting and financial players seek protection at the same time, the same ounces are chased for different reasons. One side wants continuity of production. The other wants insulation from uncertainty. The market doesn't distinguish between motives. It simply raises the price until demand slows or supply loosens. And right now, supply is not loosening. A common framing treats this as a simple contest between major economic blocs, as if one side can endlessly outbid the other. That view misses the real constraint. Commodity inflation does not stay neatly contained. It feeds back into manufacturing costs, infrastructure spending, and even defense budgets. If input costs rise too far, they begin to damage the very systems trying to secure resources. The real contest is not about who can pay more, it's about who can absorb the consequences longer without destabilizing something critical. That is why the stress is showing up across layers of the system. In Asia, higher silver prices pressure manufacturers operating on tight margins. Delivery timing becomes as important as cost. In the United States, stress appears more in the financial layer. Sudden repricing strains hedges, increases margin requirements, and tests liquidity assumptions. Neither side needs to lose for the market to reprice aggressively. Both can be reacting defensively to the same conditions. This defensive posture becomes clearer when you look at how markets behave after the initial shock. Speculative moves often reverse quickly. They spike, attract attention, and fade when momentum cools. Structural moves behave differently. They hold levels, they consolidate, they form new bases, and then they advance again when pressure resumes. Silver's behavior around $107 matters far more than the speed of the initial move. One of the most useful ways to read this is through regional spreads. When different markets price the same metal differently, it tells you where urgency exists. If spreads remain elevated, demand is still pressing. If spreads compress because the lower-priced market is being pulled higher, it suggests the stress is being transmitted rather than resolved. That distinction separates temporary dislocations from deeper supply issues. Another signal is the relationship between price and open interest. If silver rallies sharply while open interest collapses, leverage is being forced out and the market is de-risking. If silver rallies and open interest remains elevated, it suggests new positions are entering and the move may not be finished. These dynamics matter more than any single headline because they reflect behavior, not narrative. Inventory classifications are another critical piece. Large headline inventory numbers can be misleading. Not all reported silver is freely available for delivery. Some is already pledged, tied to long-term contracts, or difficult to mobilize quickly. When stress builds, the distinction between total inventory and deliverable inventory becomes crucial. A market can appear well supplied until participants discover that the usable supply is far thinner than expected. Then there are the quieter indicators that rarely get attention. Lease rates' rising signal increased demand for short-term access to physical metal. Backwardation, when present, reflects a willingness to pay more for immediate delivery than for future delivery. These are not speculative signals. They are operational ones. They show that timing matters and that some buyers cannot wait. Silver has a long history of appearing liquid right up until the moment it isn't. It trades smoothly until a relatively small number of participants decide they need actual metal in size. At that point, the depth vanishes quickly, not because silver disappears, but because the freely available supply was always more limited than paper trading implied. That is why price moves can feel sudden and disproportionate. This also explains why waiting for a clean explanation can be dangerous. By the time a consensus narrative forms, the repricing has already occurred. Markets adjust first, stories come later. Silver's move to $107 reflects decisions that were made before the price ever changed. The next phase depends on behavior, not belief. If buyers continue to step in on pauses, the market is telling you the underlying pressure remains. If selling overwhelms buying quickly, then the move was more positional than structural. Watching how silver behaves during consolidation periods will be more informative than watching intraday volatility. Looking beyond silver reinforces this view. Gold holding strength suggests demand for protection. Copper remaining firm suggests ongoing industrial demand. Energy staying volatile reflects persistent uncertainty around supply. These markets are not sending contradictory signals. They are all pointing to an environment where efficiency is being replaced by security. That environment favors assets that bridge multiple roles, and silver does exactly that. It is both a critical industrial input and a monetary metal. When growth is prioritized, silver benefits from production needs. When stability is questioned, silver benefits from its role as a store of value. That dual nature makes it especially sensitive to shifts in confidence and policy. This does not imply a straight-line move. Volatility is part of the process. Sharp advances invite pauses. Pauses test conviction. What matters is whether those pauses attract real demand or simply mark exhaustion. So far, the structure suggests accumulation rather than distribution, but that remains an ongoing process to monitor. The broader implication is that we may be transitioning into a phase where access matters more than price efficiency. In that world, hoarding becomes rational. Long-term contracts replace spot purchases. Price spikes become signals rather than anomalies. Silver's behavior fits that framework more closely than many want to admit. Silver at $107 is not just a headline. It's a warning that availability is becoming a variable again. And when availability matters, markets stop behaving like spreadsheets and start behaving like systems under stress. Another layer that is quietly reinforcing this move is the growing focus on custody and control of physical resources at the institutional and national level. When governments and central authorities begin revisiting where strategic assets are held, how quickly they can be accessed, and under what conditions they can be moved, that is not a symbolic exercise. It reflects uncertainty, and uncertainty changes behavior long before policy changes are announced. Silver may not sit in the same vaults as gold, but it exists within the same trust framework. When confidence in access weakens, the desire to control physical supply strengthens. That mindset does not differentiate sharply between metals. It treats resources as strategic inputs rather than interchangeable commodities. In that environment, price becomes secondary to certainty. At the same time, policy direction in the United States and elsewhere is shifting more openly toward securing critical materials. The language has changed. Supply chains are no longer discussed purely in terms of efficiency or cost. They are discussed in terms of resilience and security. Funding proposals, strategic reserve discussions, and domestic sourcing initiatives all point in the same direction. When governments signal that access matters, private actors do not wait. They move first, they lock supply, they drain the spot market. Price adjusts to reflect the new reality. This context reframes the question of whether silver at 107 represents a peak. Markets that move for structural reasons rarely end with a single dramatic candle. They pause, they digest, they frustrate, then they move again if the underlying conditions remain unresolved. The correct focus is not on calling the exact top or bottom, but on observing whether the market accepts higher levels and continues to attract real demand. One of the most misunderstood aspects of silver is the difference between theoretical supply and usable supply. Above-ground inventories appear large on paper, but much of that metal is tied up in long-term holdings, embedded in industrial products, or encumbered by financial claims. The pool of silver that can be mobilized quickly, delivered reliably, and used without dispute is much smaller. When demand shifts from price exposure to physical control, that distinction becomes critical. This is where silver's relationship with other critical materials becomes important. Copper, oil, rare earths, and similar inputs are all experiencing varying degrees of the same pressure. They are no longer treated as neutral commodities. They are treated as leverage points. When access to inputs becomes uncertain, hoarding is not irrational. It is defensive. There does not need to be coordination for this behavior to emerge. Strategic competition naturally creates it. Policy shifts encourage it. Market participants respond to incentives. When enough participants decide that waiting carries more risk than paying up, prices move sharply. Silver reacts quickly because it is used broadly, difficult to substitute on short notice, and hard to stockpile quietly at scale. This perspective also clarifies why simplified narratives fall short. The idea that China is being squeezed misses the broader issue. Even if China can afford higher prices, affordability does not guarantee access. Delivery timing, routing, and reliability matter just as much. If access appears uncertain, buying accelerates, which tightens conditions further. That dynamic feeds on itself. Similarly, the idea that a single U.S. institution must be failing is too narrow. Sudden repricing stresses the financial system through margin requirements, hedging costs, and liquidity assumptions. That stress does not require collapse to influence behavior. It only requires enough participants to decide they cannot afford to be wrong. When that happens, markets reprice to discourage risk. What matters more than opinions is behavior. Watch how spreads behave after the initial shock. Watch whether regional premiums persist or compress through price rather than flow. Watch delivery activity and inventory classifications. When deliveries increase and available inventories decline, the narrative shifts from speculation to access. That is when volatility becomes persistent rather than episodic. The broader market backdrop reinforces this interpretation. The dollar remains soft. Long yields drift without resolving decisively. Equity markets hold up, but volatility stays elevated. Gold maintains strength, silver outperforms, copper remains firm, energy stays unsettled. These signals are not contradictory. They point to a system adjusting to overlapping pressures rather than a single event. Silver's dual role makes it especially responsive in this environment. It benefits from industrial demand when growth continues, and it benefits from monetary demand when confidence weakens. Few assets straddle those worlds as clearly. That is why silver often moves late and fast. It remains ignored until it suddenly cannot be. This does not imply that silver moves in a straight line from here. Volatility is part of the process. Pullbacks test conviction. Consolidations frustrate participants. What matters is whether those periods attract buyers who are motivated by necessity rather than momentum. That distinction determines whether a move is temporary or transformative. The deeper implication is that markets may be transitioning from an era focused on efficiency to one focused on resilience. In that world, price efficiency gives way to supply security. Hoarding replaces just-in-time sourcing. Long-term contracts replace spot exposure. Price spikes become signals rather than anomalies. Silver's behavior aligns with that shift. Silver at 1.7 is not simply a reaction to headlines. It reflects a growing preference for certainty over optimization. When enough participants share that preference, markets reprice to reflect it. That repricing can feel abrupt because it compresses years of assumptions into days of price action. As this develops, the most valuable skill is clarity. Ignore noise, focus on structure, observe spreads, inventories, and delivery behavior, monitor policy language. These elements reveal far more than commentary ever will. Markets speak through actions long before they explain themselves. Silver's move is not about excitement, it is about adjustment. It is the system responding to a change in priorities. Whether that adjustment continues depends on behavior, not belief. If access remains uncertain, price will continue to reflect that uncertainty. I'm John A.G., and the next phase will be defined less by charts and more by logistics. When markets look calm on the surface but tense underneath, the most important decisions are already being made. Stay disciplined, stay focused, and remember that when availability becomes the issue, price is only the messenger.